All right. Hello, everybody on YouTube. We just went live on YouTube. Please let me know how the quality is. Sound quality, camera quality. Is everything all right on YouTube? Can you see the screen from Uber Investor Relations? I'm going to end it on X. If you're watching on X, head over to the YouTube channel. Let me know how the audio and visuals are on YouTube. All right, sounds great. Perfect. Ethan, thank you very much. All right, Uber announces results for third quarter 2024. Gross bookings grew 16% year over year and 20% year over year on a constant currency basis. Okay, so let's take some notes. November 16. These results were announced by Uber 2 weeks ago, October 31st. This is Uber Q3 2024 results. There's going to be some takeaways from this earnings release on Tesla's robotaxi business. All right, 20% growth year over year on a constant currency basis. So 4% impact from currency. This is important in part because the US dollar has been strengthening, and especially since in the last two meetings of Jerome Powell, he signaled that they're ready for a pause. So he's kind of opened the door for. They haven't made a decision just yet. They're going to get some more data before the next meeting, but they're getting ready, I think, for a pause in December. And this is not what the market prices. So there might be some movement across asset classes for this pause, and that will lead to an increase. It might lead to an increase in US dollar, and as the US dollar increases against other currencies, that reduces the value of revenues and profits shared generated by Uber and Tesla in other countries. Because if you make a sale in China or Europe, you're obviously not going to pay in US dollars, but at each quarter end, that needs to be converted into US dollars. So as the US dollar increases in value, the value of the revenues and profits generated in other countries goes down. Okay. And that's what you're seeing here. Uber says at the top, gross bookings grew 16% year over year, 20% year over on a constant currency basis. So if the US dollar hadn't increased in value, that would have been 20%. We are going through on YouTube the Uber earnings Q3 2024 results. We're going to first go through the press release, read management commentary, go through the financial statements, and then we're going to listen to the earnings call, just like we did with the Rivian. Head over to the YouTube channel, hit the like button, share the video with your followers to help us grow, and subscribe to the channel. Thank you very much, everybody. All right, let's continue. Uber Technologies today announced financial results for the quarter ended September 30th. We delivered yet another record quarter for profitable growth at a global scale, reflecting the strengths of our platform, which now has 25 million Uber One members. Okay, 25 million Uber One members. So I'm just going to take note of some of the key, metrics that they share, and kind of skip through the management fluff. We continue to build an eye toward the future. That's fluff, optimizing products for new customer segments and geographies, introducing the rider verification nationwide to increase safety for drivers. Okay, so this is something that Tesla robotaxis won't have to deal with, right? Because there's no safety of drivers. And robotaxis also improve the safety of riders as well, because there's no driver. And launching shuttles to airports and venues. Okay. And of course, we continue to advance our autonomous strategy, demonstrating how Uber can unlock this exciting technology for the world. Okay. Fluff. We hit another important milestone this quarter, delivering over 1 billion GAAP operating income for the first time in our company's history, and our track, 1 billion GAAP operating income. So that's an important milestone. 1 billion GAAP operating income. So that includes GAAP means, in this case, I'm guessing, includes depreciation, whatever depreciation they have. They're not really an asset-heavy company, so, but also stock-based compensation is going to be included in those expenses. So that's 1 billion, over 1 billion. Yeah, that's actually very good. Okay. Thank you very much for those of you in YouTube live chat who let me know your code check number and encourage others to like the video and subscribe to the channel. I really appreciate that. Okay. Financial highlights for third quarter. I can probably air this on X as well. Let me see 1 second. All right, this should be live on X as well now. So there should be an X video at the same time as YouTube going at the same time. Perfect. All right, I'm going to end the YouTube space. X space. And we're going to be live video on X and YouTube. Okay. But if you want to participate in YouTube live chat, you can do it on, head over to the YouTube channel and do it on YouTube live chat. All right. Okay. So let's see. Back to the earnings release. We just went through the first page or the first half of the first page on YouTube. You can head over to YouTube channel and start from the beginning while this live stream is going on. We hit an important milestone. Okay, we went through that. Financial highlights. Gross bookings 16% year over year to 41 billion, or 20% on a constant currency basis, with mobility gross bookings of 21 million. Okay, so mobility is the Uber rides, and then deliveries are mostly the Uber Eats. So it looks like it's a 50-50 business at this point. So half of the business is coming from Uber rides, and about half coming from delivery gross bookings and trips during the quarter. Gross bookings 21, delivery, if you add those up, 39.7, but that's 41. So there's 1 billion something else there. We'll look into that later on. Trips during the quarter grew 17% year over year to 2.9 billion trips. That's incredible. Approximately 31 million trips per day on average. This is incredible. I mean, I think we should kind of step back and recognize that when Tesla announced its Robotaxi event was going to happen, I think this was March or April 2024. So just 6-7 months ago, when Elon announced it, Uber stock dipped a little bit, and I got a lot of heat. There were a lot of people saying that Uber is going to go bankrupt, is going to go to zero. Tesla Robotaxi business is going to kill it, etc. And I said, not that fast. First Tesla has to develop the FSD technology to a reliability level that is necessary for Robotaxi business, and then it has to start the business. Then that business has to be adopted, and whether that's going to be city by city, as Waymo and Cruise have been doing, or state by state, or the federal level. Now with the Trump administration, it's TBD. And even after that happens, the adoption is going to depend on the pricing and other factors. So, it's too early to short Uber stock based on expectation that Tesla is going to start the robotaxi business. Okay. In this Uber Q3 2024 earnings release, we are looking for tidbits that we can apply to Tesla. Okay. Revenue grew 20%. So give me 1 second. So trips during the quarter grew 17% year over year. Mobility gross bookings grew 17%, or 24% year over year on a constant currency basis. So pricing must have increased on a constant currency basis. So that tells me maybe in international markets, they had a bit more pricing power, since adjusted for currency impact, it's about the same, 70%, 17%. So that's okay. TBD, we can look into that a little later. Maybe they'll make a comment about that on the earnings call. Revenue grew 20%. year over year to 11.2 billion, 22% on a constant currency basis. Combined mobility and delivery revenue grew 23% year over year to 9.9 billion. Okay. Income from operations, 1.1 billion, up 667 million year over year. That's incredible. Yeah, that's incredible. So we'll look into what was the driver of this. Revenue up 20%. So that's about 2 billion. Operating income up 667. Okay. That's amazing. So there's lots of operating leverage, obviously, in the business. Net income attributable to Uber Technologies was 2.6 billion, which includes a 1.7 billion benefit pre-tax due to net unrealized gains related to revaluation of Uber's equity investments. Okay. We'll look into that too later on. I'm sure that will come up. Adjusted EBITDA of 1.7 billion, up 55% year over year. Adjusted EBITDA margin as a percentage of gross bookings was 4.1%, up from 3.1%. Okay. Net cash provided by operating activities was 2.2 billion, and free cash flow defined as net cash flows from operating activities less capex was 2.1. Okay, so very little capex expenditures. Share repurchases, 375 million of our common stock under February 2024 authorization. Let me look up something real quick. Uber is worth $154 billion at 36 PE ratio. They repurchased 375. Call it $1 billion per year rate. Less than 1% per year. Okay. Any questions, comments so far? Kochek 14, you look better with a beard. Okay, thanks, Libby. Uber Eats is huge part of this platform. Wow, who knew? Yeah, exactly. I mean, that's why we do this thing. Is when we think about the Tesla robotaxi business, it's not just going to be about the rides. It's also going to be about delivering food and other things, and maybe Optimus will play a role here as well. And looks like for Uber, globally, it's 50-50 right now. 50-50 between rides and Uber Eats, which is amazing. So that's a good observation from True to a T, who is a great supporter of the space. Thank you, Marty, for letting me know your code check number in YouTube live chat. Appreciate that. All right, let's continue. Unrestricted cash equivalents, and short-term investments were 9.1 billion at the end of the third quarter. We expect to redeem 2 billion of our outstanding debt in Q4. Okay. Q4, we anticipate, so this is the outlook, gross bookings of 42.75 to 44.25 billion, which represents 16 to 20% year-over-year growth. Okay, so I mean, it's a 20% year-over-year growth kind of business. And with high operating leverage. I'm taking notes. Trips year-over-year growth will be similar compared to Q3. Our outlook assumes a roughly 2 percentage point currency headwind to total reported year-over-year growth. This is something we can probably take away from Uber to Tesla as well. There's going to be some currency headwinds for Q4 for Tesla as well. I don't think the breakdown between US business versus international is the same, but they're both global businesses. So we should expect some currency headwind in Tesla's Q4 results, including a roughly 5 percentage point currency headwind to mobility's reported year-over-year growth. Okay, and I think that has to do with the geographical composition of the mobility business versus the delivery business. Adjusted EBITDA of 1.78 billion to 1.88, which represents 39 to 47 year-over-year growth. I mean, you can see the profitability growth is double the revenue growth. So that's also speaks to the operating leverage in the business. Financial operating highlights: monthly active platform consumers increase of 13%. Interesting. Trips 17%. So people are taking more trips. So more trips per person, per user. Gross bookings is 20. Revenue 22%. That's also interesting. There's a bit of a difference on a constant currency basis, and also the other one as well. So I guess that means payments to drivers went down a little bit, or that's one possible explanation. Income from operations, 169% growth. Adjusted EBITDA, 55% growth. Net cash provided by operating activities, 123%. I mean, these are incredible results. Okay. Q3 net income includes 96 million net headwind pre-tax from reevaluation Uber's equity investments. Q3 2024 includes $1.7 billion. Okay, we don't know. I don't know what the equity investment, but we'll find out later on. Net cash provided by operating activities and free cash flow for Q3 includes an approximately 622 million cash outflow related to payment of HMRC VAT assessment, value-added tax. Okay. These are not really related to Tesla's business, so we can just skip these. If I was analyzing Uber, I would have to look into those things as well. Gross bookings, mobility, delivery. On a constant currency basis, mobility grew faster. There's also freight. There you go. That's the 1 billion. Okay. Pretty much 50-50 here. Mobility and the rest of the business. Revenue. Mobility, delivery, freight. Similar growth rates. Revenue margin. Mobility revenue margin. I've never heard of revenue margin before, but I'm guessing that has to do with, let's see. Mobility revenue margin Q3 and Q3 2024 was negatively impacted by business model changes in some countries that classify certain sales and marketing costs as contra revenue by 90 bips and 150 bips respectively. Yeah, so the 70% is most of the money that goes to the drivers, I'm guessing. So gross bookings minus money to drivers, other costs, and I'm guessing that's what they mean by revenue margin. Adjusted EBITDA and segment, we'll find out more when we look at the financial tables. Adjusted EBITDA segment, adjusted EBITDA. This is profitability. EBITDA is earnings before interest, tax, depreciation, amortization, just a measure of profitability. Mobility increased 31%, delivery increased 52%, freight dropped 46%. Okay. Includes costs that are not directly attributable to our reportable segments, corporate G&A. Okay, that's fine. Financial highlights, mobility. Revenue of 6.4 billion, mobility revenue grew 26% year over year. Let me just see if there's any questions, comments. Marty says, Cybertruck has thousands of pounds on lockable storage via its bed. This should be a huge revenue stream in the future. Yeah, in the delivery business, I think that could play a role. And then Marty Stanko says, how do you currently have your deliveries done? How do you see Tesla autonomous vehicles changing it? Yeah, I mean, if you want to join the party, go to the live chat on YouTube channel. The link is in my bio on X, but it's basically youtube.com/@valueanalyst1. Mobility revenue of 6.4 billion. Mobility grew 26% year over year. Let me just skim through if there's anything that we haven't covered just yet on the above. Adjusted EBITDA. Nothing. I want to get to the earnings call. Delivery, primarily attributed to increase in delivery gross bookings due to increase in trip volumes and an increase in advertising revenue. Okay. Delivery adjusted EBITDA margin improvement year-over-year was primarily driven by better cost leverage from higher volume increased advertising revenue. Okay. Freight, just skip that. Corporate platform R&D. Improve fixed cost leverage. Nothing too specific there. Cost of revenue excluding DNA. Nothing that relates to Tesla there. Kind of just let me read through it. Okay. Operating highlights for third quarter. Platform. Monthly active platform reached 161 million, grew 13% year-over-year, driven by continued improvement in consumer activity for both our mobility and delivery offerings. Trips of 2.9 billion, we covered that. Sporting earners. Okay, let's kind of think through this a little bit. Sporting earners. Drivers and couriers earned an aggregate 18.1 billion, including tips during the quarter, with earnings up 14% year-over-year or 21% on a constant currency basis. So there you go. The earnings to drivers and couriers increased 14%, even though revenue increased on a higher rate. So Uber's, there might be some leverage in the revenue item as well, which is kind of interesting idea here. But maybe we should look into that. Like there's operating leverage, but in Uber's case, there's gross bookings and then payments to drivers, couriers, and they have the net revenue. I think that's what they mean by revenue margin. So, I mean, anecdotally, I've heard of people complaining about the Uber drivers' shares are getting less and less. Uber's taking more and more over time. So maybe that's what it has to do with, but something to keep in mind. Announced 20 plus improvements to earner experience, including nationwide launches of enhanced rider verification and record my ride feature, greater service fee transparency, and a redesign of the Uber driver app. Okay. New and expanded autonomous partnerships, expanded our multi-year strategic partnership with Waymo. There you go. To bring autonomous ride-hailing to Austin and Atlanta, only on Uber. In addition, we announced 5 new autonomous partnerships across mobility and delivery. Cruise, Coco, I've never even heard of that company. Wave, Reride, Evride, I've never heard of them. But Uber is becoming a platform for robotaxis. Okay, and whether Tesla will sell the cars to Uber or individual owners of the cars will add the Tesla robotaxis to Uber network, or fleets will buy Teslas and add them to Uber network. I don't know. Versus Tesla operating its own fleet. My guess is that Tesla will operate its own fleet, but we'll see. Matt Sanko says X needs a mechanism for live chat. I agree. I don't think the comment section on X or the replies to on X is conducive to this kind of thing. So head over to YouTube live chat and engage with others, ask questions, make comments, ask questions to me or others. True to a C says, Matt, we utilize all Dash Eats, Grubhub. Cost is high on both our end and customer end due to obvious operational costs. Energy efficient vehicle, no driver cost, etc. will be game changer. Okay. Optimus will play a role. Okay, good. All right, let's continue. Membership debuted. So one second, Waymo is coming to Austin, Atlanta on the Uber. I haven't heard of Austin. I haven't heard of Atlanta. So that's the first time I'm hearing about that one. Uber and Waymo. I'm just taking notes in Austin and Atlanta. These are the things that I'm going to bring to Tesla Live spaces over the weekdays. So I try to, whenever I get a chance, host these watch parties on YouTube and grow the channel, but also gain some insight for Tesla investors. Membership debuted our Uber One for students back to school college campus tour around the US and expanded Uber One for students to Canada with additional countries planned by year end. Our gold member base surpassed 25 million. Advertising. So this is one that people don't really talk about in the context of Tesla robotaxis, but it's clearly becoming a primary source of revenue and profits for Uber. So let's see what Tesla does on that front. William, thank you very much for letting me know your co-check number in YouTube live chat. All right. Advertising launched a pilot of our first impression ad format, which allows advertisers to temporarily take over the home feed to promote new products or offers. Interesting. First impression ad format. Also began to integrate our exclusive partnership with T-Mobile Advertising Solutions, which will expand our Journey TV offering to over 50,000 vehicles across the US. Family profiles with teen accounts launched several new features for teen accounts to enhance convenience and security, including the ability to guardians to book trips on behalf of teens. Mobility. Hailables partnerships. Announced that we will return to Denmark in collaboration with a local taxi partner. In India, expanded our Moda partnership with the country's largest third-party logistics provider to 6 new cities, opening up new supply channels. Lastly, launch our first taxi integration in Latin with Brazil's largest taxi-hailing app, providing access to 70,000 drivers nationwide. So you may have, if you want to grow international markets, you may have to partner with the local companies and to get regulatory approval, I guess. Bit of a nationalism, but low-cost mobility offerings expanded Uber Shuttle to LaGuardia with trips offered between the airport and major transit hubs in Manhattan every 30 minutes. In addition, began testing walk-in and waiting for Uber X Share in select markets to support greater discount for riders. Electrification. Introduced several new features to accelerate electrification. For consumers, launched all-electric Uber Green, allowing for an EV-only ride option in 40-plus cities globally. Alongside an EV preference feature in other markets. For drivers, announced an AI assistant to help answer EV questions and an EV mentorship program. I found that when people say AI assistant, it's like, I don't exactly know what that means. I mean, I don't know how Uber can be a major AI player without having, building out their own training cluster like Tesla is and the other hyperscalers are, spending billions of dollars in GPUs. And I don't think Uber is doing that because I don't see it in their CapEx numbers. So this may just be a, talk. Travel enhancements. Launch a new feature to let riders search and explore Uber offerings in 10,000 plus cities around the world, to reserve rides for upcoming trips and see insights into the average on-demand wait time and cost of a ride in that city. In addition, launch a flight capture and assistive time picker features in all reserved cities, allowing riders to add their flight details and get a suggested pickup time for their reserved airport trip. Okay. Turo announced a multi-year partnership with Turo, the world's largest peer-to-peer car sharing marketplace, to enable Uber customers to rent from Turo's wide-ranging selection of vehicles directly from Uber app. That's interesting. Okay. Delivery, merchant growth and discovery features. Launched Bites, a dish-centric short-form video feed to boost discovery and help restaurants showcase their dishes in select cities, with plans to continue expansion this year. Launch Uber Eats lists, enabling consumers to discover curated recommendations from friends and local foodies. Yeah. Okay. Uber direct expansion. Yeah, it's gonna be. I mean, it's not gonna be easy competing with Uber for Tesla. For those of you who just joined, we have 600 viewers right now. This we're going through the Uber Q3 earnings release, and then later after that, we're going to listen together to the earnings call. So I often host these watch parties. We did one with Rivian. We had quite a bit of takeaways that we can apply to our knowledge of Tesla, and we're doing the same with Uber. And we're going to continue to do these. So I highly recommend people join the YouTube channel, engage in live chat, ask questions. If you don't understand something, stop me, ask so I can explain. Because if you have a question, likely a lot of other people among the 600 view right now and the thousands that are going to watch this later on had the same question. So don't be afraid to ask questions in live chat. Uber Direct expansion. Launched and expanded Uber Direct partnerships, including a new multi-year partnership with Darden, okay, grocery retail merchant selection, sustainability enhancements, climate collection, and Uber Eats app to make it easier for consumers to order sustainable brands, okay, courier pick and pack expansion. All right, so these are all operational issues that are very interesting. It just doesn't really apply to Tesla right now. Freight, skipping that, it's very small. Corporate. Actually, let me just read this. AI and software advancements. Announce a new advanced features for Insights AI, including enhanced chat functionality KPI dashboard that delivers real-time actionable insights. Additionally, upgrade the Uber Freight Transport Management System with an intuitive tracking portal, simplified doc scheduler, and upgraded financial management tools. Investment grade debt issuance, complete a registered public offering of 1.25 billion senior notes due 2030, 1.5 billion senior notes due 2035, 1.25. So it's a collection of four due 2054. Okay. We're presenting our first issuances as an investment grade rated company. Interesting. Additionally, entered into a new $5 billion credit agreement. We expect to redeem $2 billion of our outstanding debt in Q4. Interesting. So this is interesting because so they just generating more operating income, 1.1 billion operating income in Q3. So that's a run rate of about 4 or 5 billion, assuming there's no seasonality. But then on top of that, they're raising cash through debt issuance, 4 or 5 billion. And then also another credit agreement, which is more than twice as much as the outstanding debt they're going to redeem. So what are they getting ready for? It sounds like they're getting ready for something, either some sort of major investment or acquisition or something. Interesting. Because otherwise, why would you issue this debt at an environment where you have high rates? All right, we're going to listen to this in a little bit. Mission is to create opportunity through movement. We started 2010 to solve a simple problem. How do you get access to a ride at the touch of a button? More than 55 billion trips later, we're building products to get people closer to where they want to be by changing how people, food, and things move through cities. Uber is a platform that opens up the world to new possibilities. Okay. Keep it through the legalese here. Balance sheet. Let me see if there are any questions before we start here. Can I ask something? Yeah, you can ask something. Go ahead. Maybe buy their own fleet in autonomous cars. Yeah, maybe. But yeah, so Marta suggests that maybe Uber is looking to buy their own or build their own fleet of autonomous cars. So how would that work? They would just, I guess, go into a partnership with Waymo, buy from manufacturers, pull Waymos, and it would sit on Uber's balance sheet. But Google just invested 5 billion into Waymo too. So it sounds like they're trying to get their own fleet going as well. I don't know. There were some rumors that Uber is going to invest into another company, buy out another company. and that the CEO used to work for or something. But I think the CEO kind of said that's not what they're trying to do right now. They focus on organic growth. So Marty's idea might be a potential explanation here. But they would have to buy the equipment for Waymo too. So I mean, unless you're thinking about Tesla Cybercabs or whatever, but that's not in production. So how would that? Why would they raise money for it now? I don't know if that makes sense. Let's. I mean, we'll look through the balance sheet and maybe that will give us some more ideas here. And then new faces acquire Airbnb. What's Airbnb's market cap? Let's see. 84 billion. Yeah, you're not going to be able to do that with a couple $1 billion. I don't know. Interesting stuff. Hard to comprehend. True to a T, a great sport of the space says, hard to comprehend why Uber and Tesla don't join forces in some form. I mean, I think one explanation is that Tesla, I mean, Elon always wants to kind of vertically integrate and control, especially control the user experience. And if you partner with Uber, you're not going to be able to do that. And so, I don't know. I don't see Tesla selling cars to Uber, honestly, but I've been wrong before, so we'll see. Matt Senko asks, do we expect Waymo or other autonomous transport companies to compete with Tesla Uber? I mean, it sounds like Waymo is trying to partner with Uber, and if Uber has a shot or Waymo has a shot at beating Tesla, it's through partnership. If everybody else except Tesla gets together and competes against Tesla, that's their best shot of beating Tesla, because none of them have all the pieces. So Tesla has the manufacturing, very good at this point. Cybercab is designed for high manufacturability with lower number of parts, and Tesla has in-house AI training cluster. Uber doesn't have that. That's going to have to rely on Waymo for that. Waymo has the hardware and software piece, the inference and the training piece of the AI needed to drive these cars. But who are they going to partner with? Manufacturing side, that's TBD, I guess. But I think they're trying to agnostic. But I think also Neuralink will play the role 10 years down the line. But so we'll see. It's going to be interesting. I just don't think it's as clear as most people make it out to be. Like a lot of people thought when Elon tweeted that they're going to have an 8/8 Robotaxi event, a lot of people thought that they should short Uber, that Uber's going to zero. There was some activity on after hours after the announcement of Uber stock going down. People thought that that was the end of Uber, but I actually got a lot of hate for saying it's probably not the case. It's going to be a long road. And Uber today is trading very close to all-time highs at $154 billion with healthy and growing profitability and buybacks. So, all right. Let's see. Balance sheet. We have the year-end 2023, September 30th, 2024 on the right-hand side. Cash, short-term investments, restricted cash, accounts receivable. Just kind of going through restricted cash for beyond 1 year. I'm going to go through and see if there's anything huge that kind of sticks out here. I don't really see much. There's a bit of a goodwill impairment going on here. That's probably a 10Q type of item. Okay. 47 billion total assets. Accounts payable, alpha levels, there's no increase over here. Accrued liabilities have increased a little bit. The only difference between accrued liabilities and accounts payable is invoicing. That's the only difference. Invoicing from the supplier. Okay. So these are incurred expenses that are not yet invoiced. These are incurred expenses that are invoiced. That's the only difference. I actually look at them on a combined basis. Long-term insurance reserves, Long-term debt, another current portion. Operating leases. So, okay. Nothing really that sticks out here on a major basis. Let me just take a look at the senior debt note again. Completed registered public offering of 1.25 represent first issuance. Additionally, entered into a $5 billion credit agreement. That's not going to be unless they. I mean, yeah, that's not going to be on the balance sheet. Expect to redeem $2 billion. So this should be on the balance sheet. So let's take a look at the cash flow statement, see what they did with that money. Maybe it's just sitting here. Okay. Income statement, 3 months, third quarter Q 2023, third quarter 2024, not year to date 2023, year to date 2024. I'm just trying to see if there's any huge changes here. Sales and marketing went down 10% year over year in the 9 months. That's interesting. In the Q3, it went up. So the improvement came from, there's a $500 million improvement in the first 6 months of the year. R&D, stable. G&A, up 500 million in the first half. Up 500 million, down 500 million sales. So that might be a reclassification going on. Actually, there was a note here. Maybe that's related. Let me see again. It includes costs that are not directly attributable to corporate G&A also includes certain shared costs as finance, account, tax, human resources. Platform R&D also includes mapping and payment technologies and support and development internal technology. Allocation methodologies periodically evaluated may change. Okay, I don't think that's the one. All right. I'll look at the 10Q later. Okay. Interest expense, stable. Actually went down. Huge improvement in net income. Part of it is because of this. Provision, income taxes. No, that's not why. Where's the equity investments? There you go. Part of it is because of this. Actually, that's more than 100% improvement. Yeah, that's interesting. All right. Equity investments. Right. Income from operations, other income. Oh, okay. I see. That's together. And then, so there's a $1 billion increase in other income. That's the equity method investments. So 2.5, about 40% of it is due to equity investments. Okay. So majority from operations. Cash flows. Any questions so far? Robotaxi event, did the 10% marketing for them. Would use of Tesla fleets come under operating leases? I don't know. That's a good question. I mean, it would be on the balance sheet. I don't know if it would be under operating leases. There might be a new line item for it eventually. But I think this is years down the line. But a good question, Crunch. Another great supporter of the space. Marty says, I see Tesla and Domino's Pizza type restaurants teaming up with Tesla, having built in ovens, delivering pizza and other food items amazingly quick to customers. Maybe. All right, people are talking about the third-party fleets in live chat. All right, let's continue. Cash flow. Give me 1 second. All right. Cash flow. Depreciation, amortization declined. Interesting. Net income. Start with net income, and then add back non-cash expenses, take out, and then there's some adjustments on working capital here. Depreciation, bad debt expense, immaterial. Stock-based comp declined. That's interesting. Deferred income tax, immaterial. Unrealized gain and loss on debt and equity securities. These are gains. Interesting. Okay. Nothing too major in working capital stuff. Net cash provided by operating act. This is amazing. I mean, $5.4 billion in the 9-month period. That's amazing. This is CapEx. They have very low CapEx. I mean, it's a very asset-light business. That's amazing. They generated about $2.1 billion of free cash flow in third quarter 2024. Yeah. Yeah. 2.6 billion net income, 2.1 billion free cash flow. Okay. Purchase of marketable securities. These are probably just treasury bills, I'm guessing. Companies don't want the cash to just sit in cash, especially in this interest rate environment. They buy marketable securities. It might be money market funds or treasury bills, to kind of cash equivalents to earn some interest income in the meantime. Tesla does this to Apple does it to a greater extent. And then those things just roll out as they expire. Proceed from maturities of marketable securities. When they mature, these treasury bills, or when they sell the money market funds, they just reinvest into this. So a lot of times you'll see these big numbers, but it doesn't really mean much. Financing section. So this is the operating section, investing section of the cash flow statement, and this is the financing section. Sorry, financing section. Okay. Issuance of term loans. This is what they talked about earlier, about $4 billion senior debt. Principal repayment of term loans. So they repay $2 billion of those, of the old ones, and then 2 is in cash. And cash equivalents. Okay. $9 billion of cash at the end of the period, September 30th, 2024. We still don't know what exactly this is, but we'll see. Actually, you might say here. During the 3 months ended September 30th, 2023, that's 2023. Where's our 2024? During the 3 months ended September 30th, 2024, unrealized gain on debt and equity securities now represent changes in the fair value of our equity securities, primarily including $1 billion unrealized gain on Aurora investment, Didi investment, that's the Chinese company. Yeah. Delivery Hero Investment. So they make kind of venture capital type of investments into these companies or private equity, whatever you want to call it. And they have to record, depending on their ownership percentage in that target company, there's different accounting methods. So in this case, they're, I think it's called equity investment method or something along those lines. Okay. And grab. All right. So they have a bunch of portfolio investments. Stock-based comp. It went down, we said. So let's see what went down. R&D went down and G&A went down. Okay. Skipping that. Aggregate driver, courier earnings, fares, tips, net of Uber service fee, tax and tolls, driver incentives, driver benefits. Okay. Okay. Free cash flow, gross bookings, monthly active platform, revenue margin. We define revenue margin as revenue percentage of group gross bookings. Okay. That's what we guessed. Okay. Just some more terminology. Constant currency, we know all that stuff. Reconciliation, not that interesting in this case. Free cash flow, we know what that means. Okay, let's listen to earnings call. So far, first hour, we went through the earnings release. You can listen to from the beginning on YouTube, even as this live stream continues. So head over to YouTube channel, youtube.com/@ValueAnalyst1. And subscribe to the channel, help us get to our 10,000 subscribers goal. Any questions, let me know. We're going to start soon with the earnings release, earnings call. So we finished the earnings release. We're going to switch to the earnings call. And I'm going to pause it if there's something that I believe is related to Tesla or they can be taken away for Tesla. And we're going to go, and that should take about an hour as well. Steven says, I don't see Uber going away. They just need to transition to robotaxi and eliminate the drivers. Would purchase in robotaxi from Tesla be beneficial to both companies? Yeah, we talked about this earlier. I think that I think it's very unlikely that Tesla will, Uber is a great company. It's very efficient. They're growing really well. 20% top line growth, even faster bottom line growth, high operating leverage, good networking effect. They've expanded to many international markets, which obviously is a lot of friction that they've handled. I think it's going to be very difficult for Tesla to disrupt Uber, especially, and I know many bulls don't agree with me on this, but especially as more tasks and roles that Elon takes, it's going to be even more difficult for Tesla to disrupt Uber. But it's not impossible. And Elon is very much focused on, vertical integration in all of his businesses. And I think wants to be able to shape and control the user experience. So, of course, if you're selling the cars to Uber, you're not controlling the user experience. So I think that's TBD. My guess, my hunch is that Tesla will operate its own fleet mostly. Okay, let me find this call real quick. And there's the PDF. Okay. There's some supplemental information, prepare remarks, transcript. I really like it when companies provide the edited transcript on their investor relations. I don't know why Tesla doesn't do that. It should take like literally a couple hours. All right, let me go through. All right, we have, okay, so how am I going to do this? Let's see. Give me 1 second. Okay, great. I think they show the slides, so that's perfect. All right. Let's switch to this tab. I'm going to drop the link to the transcript in live chat and on YouTube. And if you want to read along with me as they talk, like that sometimes increase the, like at least for me, it increases my comprehension of what's being said if I can both see it and listen to it at the same time. So that link is right in YouTube live chat now. And you can follow along. Here is the earnings call tab. Okay, let me see if I can make this a little. That's fine. Only 43 minutes, which is great. We should be done here in about, so I think we're going to keep the whole thing to 2 hours. That's the goal, okay? Keep the whole thing to 2 hours. All right, let's get started. Let me know if you can't hear it, okay? Let me know in live chat if you can. How the audio quality? If you can't hear it, let me know.
Hello, and welcome to the Uber third quarter 2024 earnings conference call. All lines have been placed on mute to prevent any background noise. Following the speaker's remarks, there will be a question and answer session. And if you would like to ask a question during this time, please press star 1 on your telephone keypad. I would now like to turn the call over to Deepa Subramanian, Vice President, Investor Relations. You may begin.
Thank you, operator. Thank you for joining us today, and welcome to
Hello, and welcome to the Uber third quarter 2024 earnings.
Operator. Thank you for joining us today, and welcome to Uber's third quarter 2024 earnings presentation. On the call,
Hello, and welcome to the Uber third quarter 2024.
You should not place undue reliance on forward-looking statements. Actual results may differ materially from these forward-looking statements, and we do not undertake any obligation to update any forward-looking statements we make today, except as required by law. For more information about factors that may cause actual results to differ materially from the forward-looking statements, please refer to the press release we issued today, as well as the risks and uncertainties section described in our most recent Form 10-K and in other filings made with the SEC. We published our quarterly earnings press release and prepared remarks, supplemental slides to our investor relations website earlier today, and we ask you review those documents if you haven't already. We will open the call to questions following brief opening remarks from Dara and Prashant. With that, let me hand it over to Dara.
Thanks, Deepa. Uber delivered yet another strong quarter, a record quarter of profitable growth, with gross bookings up 20% year on year in constant currency. We also generated an all-time high GAAP operating profits of more than $1 billion. This performance was powered by new records in audience and frequency as more people in more places are using Uber more often. Our underlying platform continues to strengthen. More than 7.8 million people now drive, deliver, or shop with Uber, earning more than $18 billion during the quarter. More than 25 million people are now Uber One members, up 70% year on year. Our advertising business grew nearly 80% year on year. And our autonomous strategy is working as our 14 AV partners are clearly understanding the significant value Uber can bring to their deployment plans. Thanks to the team for another great quarter. And before we go to Q&A, I'd like to hand it over to Prashant to briefly reiterate our capital allocation approach.
Thank you, Dara. Let me add my welcome to our third quarter earnings call. I wanted to jump in quickly with an update on our share repurchase program, as well as a reminder of the capital allocation framework that we presented at the investor update back in February. Our capital allocation priorities remain unchanged, responsibly investing in future growth and returning capital to shareholders. On the growth front, we believe we still have a huge amount of organic opportunity in front of us, including our fast-growing portfolio of new products, which are now cooking at $20 billion of annual GB, with geographic expansion, especially into less densely populated markets, and lastly, with increasing user frequency, including through our membership efforts. On capital returns, we plan to steadily increase our share repo in the coming quarters. Specifically, we intend to work our way towards a durable share count reduction in 2025. Now, to quickly touch on M&A, we remain extraordinarily disciplined, and I want to emphasize that all opportunities are reviewed with a rigorous value creation mindset, and Uber's bar for M&A has never been higher. As Dara has said, the best deal is not having to do a deal at all, and we are in that enviable position today. So we are excited to continue on our exceptional path of organic growth while sticking to our firm commitment to you, our shareholder, of capital returns. So with that, let me hand it back to Deepa to open the call for questions.
Sarah, can we have the first question, please?
Okay, just to kind of do.
Thank you.
Here. So earlier when we were reviewing the earnings release, we noted that Uber raised some cash issuing senior debt, about $4 billion. They also increased their working credit agreement. That's probably for working capital. But the senior debt, we were wondering what that might be about, because they also increased their operating cash flow. Business is healthy. They have a healthy amount of cash on the balance sheet. So why would you why would you borrow money at these currently high interest rates? So that, it sounds like, after the comments from the CFO, he says, on capital returns, we plan to still increase our share repo in the coming quarters. So they're levering. They are levering the balance sheet to increase share repurchases. So that's something we should keep in mind going forward. So basically, management believes the stock price is cheaper than intrinsic value. So that's interesting. All right, let's continue. Now we're going into analyst questions. There's a whole segment. There's another PDF on their investor relations website talking about management commentary, prepared remarks. So that's why this call is shorter than usual. Usually these calls take about an hour, maybe more, a few more minutes more. And in Uber's case, it's less because they just publish a PDF of management commentary and they skip immediately after quick comments, skip to the analyst calls and analyst questions, which actually that's a good way to do it. And then they also publish a transcript, edited transcript of the call on their website. And I think every company should do that. Okay. Let's continue.
Your first question comes from the line of Eric Sheridan with Goldman Sachs. Your line is open.
Thanks so much for the commentary, especially around the capital allocation policy. I want to come back to the concept you introduced in the letter around less dense markets. Could you go a little bit deeper in both the opportunity set, but also some of the operational dynamics of building supply, as well as stimulating demand in less dense markets, and how we should be thinking about that scaling in the years ahead? Thanks so much.
Yeah, Eric, we think it's a terrific opportunity, and frankly, sometimes we kick ourselves for not recognizing it properly earlier. Uber started as a company in the middle of big cities, and our biggest cities, Sao Paulo, New York, et cetera, continue to be the largest source of demand. But continuously, we've seen that our growth outside of the core, in the boroughs of New York, now extending into the suburbs or in secondary and tertiary cities, has been higher than the core itself, almost accidentally. And this is true for mobility and delivery as well. And really, for us, the start of our focus on less dense areas started with delivery. In the U.S. especially, if you look at non-core cities, et cetera, it's 60-70% of the market. So the majority of the market there, generally it's growing faster than city centers as well. So we've really started focusing on improving selection in those areas. And then, like you said, then building out the liquidity that's necessary in terms of both demand and supply, couriers, and making sure that those couriers are busy. And that kind of cycle, that positive cycle of investing in supply and demand together, increasing liquidity, getting better ETAs, getting better service levels, starts to accelerate and add to itself. And we're starting to see that now in delivery, but not just in the US. We've extended this focus in the UK, Australia, really all over the world. We're looking at the density by quartile of all of the areas that we deliver to, or all the areas that we are giving mobility services to people to. And we are actively investing in those less dense areas. And we think the opportunity set there is very, very significant, both in mobility and delivery. So we think it's early days, but it is a focus of both mobility and delivery. And I think it will be a tailwind to our core business in terms of growth over the next 2 to 3 years, and hopefully even more than that.
Great. Thank you.
You're welcome. Next question.
Your next question comes from the line of Brian Nowak with Morgan Stanley. Your line is open.
Great. Thanks for taking my questions. I have two. The first one, I wanted to sort of drill in a little bit more to the U.S. mobility bookings trends. Dara, if you sort of look at how the business has trended since your investor update, are there any areas where you've sort of exceeded or come in a little shy versus where you thought the U.S. rides business would be growing? And is anything changed in sort of your outlook for U.S. rides contribution to growth over the tenure of the outlook that you gave at the investor update? That's the first one on U.S. rides. Then the second one just on Phoenix and sort of Arizona around Waymo. Anything you can share on sort of early signs of incremental volume to Uber from the Waymo partnership in that market? Thanks.
Sure, absolutely. So in terms of our U.S. mobility growth, the U.S. generally has been kind of the gift that keeps on giving. It's our largest market, little less than 50% of our GBs, but more than 50% of our profitability. So the business continues to grow and thrive. We are seeing in the U.S. a couple of trends. One is that we've been very public in terms of the substantial increase in commercial insurance costs, really that have happened over the past 2 years. And as we have passed on those increases in costs, especially in states where insurance costs are very, very high, like New Jersey or California, as we passed on those costs, we've seen the kind of the typical elasticity from consumers, which is as price goes up, the transaction growth slows down a bit. And that elasticity is usually 1-for-1. It's no different than what we've seen. And actually, we've seen our competitor do the same as well. We are seeing weekday growth.
All right, so that was interesting. So CEO mentioned that U.S. market comprises less than 50% of the gross bookings, but majority of the profits. So U.S. market is very important to Uber, and he also singled out New Jersey and California as examples of a substantial increase in commercial interest costs that have happened over the past 2 years. So as commercial insurance costs increased, especially in New Jersey and California, Uber passed on those costs to the consumer. And because of demand elasticity, Uber saw a decrease in business there, or lower growth, let's say. And that's important because Tesla is building out its own insurance program. So if Tesla can keep a lid on insurance costs going forward because it has its insurance business in-house as part of the Robotaxi program, let's say, then as Uber having to increase its insurance costs to consumers, Tesla, that can be a competitive advantage for Tesla going forward. So Tesla insurance, even though it's very small today, even though it hasn't expanded across the country beyond a few states, it can be a material part of the strategy, 5-10 years down the line. So that's something to keep in mind for Tesla investors. Okay.
Stronger than weekend growth as well. So people are definitely getting back to work. I think like the weekend party hours, maybe consumers are a little more price sensitive in terms of whether they choose to go out or not. But weekday is very strong, and Uber for Business especially is very, very strong. Overall, it's up over 50%. I'm not sure what the US number is, but it's really strong, both in terms of selling to enterprises, selling to health, selling to transit systems as well. That is definitely a bright spot for our business as well. And then we're not really seeing any, signs of consumers trading down. Like our share product is growing very quickly as match rates continue to increase. We're investing in newer product like Uber Teens to kind of bring in this new demographic into our system, and then shuttles into our system as well. So overall, we're quite optimistic in terms of how the U.S. market is developing. But, those insurance cost increases are definitely resulting in the kinds of slowdowns in transactions that we expected based on elasticity experimentation that we've done in the past. I think the good news is that while the insurance costs will continue to go up, we expect them to go up at a lower rate, so to speak, both because the market is normalizing and because we're taking a lot of action in terms of, safer routes, safer drivers, encouraging drivers to drive more safely to try to get those insurance costs down. But that's kind of a slow moving target, so to speak.
Okay, so that's yet another reference. I mean, he spent 4 paragraphs on commercial insurance cost. And he says, while the insurance costs will continue to go up, so in the coming quarters, that's management guidance for insurance costs going up. He says we expect them at the lower rate. I mean, this is also important for macroeconomic discussions as well. Insurance has been an issue, especially motor vehicle insurance has been an issue for inflation. And although this is commercial, it may not be the same thing. That's another kind of a side note. The other thing that he says is Uber is taking action to minimize insurance cost increases by selecting safer routes, safer drivers, encouraging drivers to drive more safely. But obviously, with FSD, Tesla won't have to deal with that. FSD will already be superhuman safety. So insurance could be an area where Tesla has a fundamental advantage, a durable competitive advantage against Uber in the future, 5-10 years from today. Okay, but that's important for Tesla investors, long-term Tesla investors. Okay, let's continue.
So pretty optimistic in general in terms of the U.S. markets overall going forward. And then to your second question, in terms of autonomous and incrementality, in Arizona and Phoenix, at this point, Brian, it's really too soon to tell. We have a relatively modest number of vehicles out there. We know that the experience with Waymos is absolutely terrific. It's a delightful experience. Riders are rating their Waymo driver at very, very high levels. And so we love the experience that it's bringing forth. I think the real test is going to be the expansion of our partnership, and it's a significant expansion with Waymo in Austin and Atlanta, where starting next year, you're going to get, Waymos in the hundreds in those markets. And I think then we will see whether there's incrementality as it relates to autonomous or not. But we're pretty optimistic where we sit. And I will remind you, too, that we've got 14 different AV partnerships. And not only are we expanding with Waymo that we're really happy about, but you will see expansions with many of our other autonomous partners in domestic and international markets on the AV side.
Great. Thanks, Dara.
All right, thanks, Brian. Next question, please.
Your next question comes from Doug Anmuth with JP Morgan. Your line is open.
Thanks for taking the questions. I'm going to stick with AV. Dara, can you just talk more about your goals here in doing fleet ops in an AV world and some of the ways that you'll be able to drive some greater efficiencies for AV tech providers? And then maybe you could just talk about San Francisco a little bit, perhaps any impact that you're seeing in that market from Waymo, and is there anything notable to call out on volume, frequency, or loyalty in San Francisco? Thanks.
Yeah, definitely. So generally, in terms of fleet ops, the background of fleet ops is we have been partnering and working with fleets and building up our fleet operations kind of practices for years and years. Typically, we have about 15% of our global mobility supply hours come from fleets, and this is supply that's dedicated to us. So they tend to work longer hours. They work kind of multiple shifts in terms of drivers, and the supply is dedicated to us, which is terrific. And we work with these fleets in many countries in the U.S. and Europe as well, and Spain, for example, and many other countries as well. So fleet operations is something that we built, and for example, we have special tools for fleets to be able to manage our fleets, to be able to drive high utilization of their cars based on demand, et cetera. And so we're really extending this practice to the AV space. Housing, charging, cleaning cars can be expensive. And we think just like there are advantages to a platform, a global platform being demand to drive utilization of these AV fleets, we think there's also an advantage to a global player establishing fleet operations to take care of kind of the local complex logistics that happens in a more efficient way and we think more cost-effective way for our partners as well. So it's just another way in which we want to be kind of the best demand and operational local operation platform for AV out there. And we're really excited to get started with Waymo, and hopefully we can expand from there. In terms of San Francisco, we see that Waymo's on the streets here all the time, and in the areas where Waymo operates, we do see them have category position in the high single digits or low double digits. We aren't seeing any effect in terms of our consumers one way or the other. The price is generally at a bit of a premium to X. It's more of a, call it a comfort electric type of a price out there. And it's a great product. And, we've been competing with Lyft, and in San Francisco proper, we compete with Waymo as well. But we're very happy to kind of extend our partnership with them and really start to build together in cities like Atlanta and Austin. And hopefully that'll be the dominant way forward for that partnership going.
Okay. So lots of comments from the CEO around fleet ops, how they have dedicated tools to maximize fleet operators' use of their cars, but not much, like a lot of words, but not much really that we didn't know. Nothing too specific there that we didn't know. No incremental comment. The partnership with Waymo. It's interesting that they're in San Francisco. They're both partnering with Waymo and also competing with Waymo. That's interesting. And they're extending into Atlanta, Austin. He did make sure to kind of point out that they have 14 other AV partners. I've never heard about any of them, but 14 other AV partners so he's trying to position Uber as we're not dependent on Waymo as a supplier. So that's obviously very important from an investor perspective if you have supply concentration. But that's going to be kind of the challenge, the friction that the Uber, Waymo, and other manufacturer partnership will face in the future against a Tesla-operated robotaxi fleet. So they're going to have to balance their competition and partnership. And obviously, that's not going to be as efficient and effective as an in-house operation. Vertically integrated in-house operation will likely win in a situation like that, unless Tesla robotaxis take another 10 years to come about, and Uber builds this like insane moat that is hard to disrupt. So we'll see how that plays out in the future. All right, let's move on to the next one. Any other comments, any insights that I may have missed, please leave in YouTube live chat and let me know your thoughts. All right, let's continue with the next one.
Going forward.
Great, thank you.
You're welcome. Next question.
Next question is from Justin Post with Bank of America. Your line is open.
Thank you. I guess just go to mobility bookings, decelerated 3 points to 24%. I know it's a tougher comp, but anything unusual or anything surprise you in the quarter? And then the incremental take rates and margins were quite strong in mobility. How do you think about where you are on those and the drivers of growth there as we go forward? Thank you.
Yes, Justin, I'll take the first part of that. So maybe let's start with sort of the recap of how we did for Q3. So gross bookings at 20% on constant currency, and remember that's our fourth quarter now of clocking at least 20% growth. That came from audience and frequency, as it has for the last several quarters. Audience really driving the majority of that at 13%, frequency at 4th, and then with the leverage that we've been able to drive the financial leverage, we're able to get EBITDA growing at almost 3x the rate of gross bookings growth. Your comment on sort of where's mobility headed, really we talked about trips at the Q4 level, I think in the prepared remarks, to be similar to what we saw in Q3, with a little bit of deceleration driven by less year-over-year pricing impact. And that's sort of what we're seeing down the LOB lines as well. So again, you should expect trip activity for Q4 to be sort of in line with what we saw in Q3, with a little bit less benefit from pricing. You don't see as much year-on-year increase from insurance in Q4, as well as on the delivery side. You see some of the benefits of the efforts we're making to drive affordability impacting basket size. So overall, we still feel kind of this is a large business that continues to grow at a very good rate. And I would say that think of mobility growing sort of in the low 20% range on a constant currency basis in Q4, and then EBITDA margin probably flattish sequentially.
Great, thank you.
Next question.
Your next question is from Mark Mahaney with Evercore. Your line is open.
Okay, I'll just double click two things on the insurance costs. So Dara, just talk about where are those in international markets? Is that primarily a U.S. market problem and specific state problem, or is that a global challenge, the rising insurance costs? And then let's talk about advertising a little bit too. So that growth is pretty robust. The sustainability, that's very high growth rate that you're doing, 70-80%. The sustainability of that, or as you think about the opportunities, and particularly on the delivery side, where do you think you are? There are lead markets where you're at several percentage points of bookings, and most of the markets you're well under 1%. Just talk about that path of adoption. Thanks a lot.
Yeah, thank you, Mark. This is Prashanth. I'm going to take insurance, and Dara's going to take ads. So insurance is primarily a U.S. phenomenon for us, where we provide insurance to our drivers when they are on their way to pick up a rider, and then again when the rider is on trip. We talk about this in prior quarters that we've seen pretty steady increase in insurance, and this last quarter was no different. The CPI for motor vehicle insurance in the U.S. was up 16% year over year in September, but that is starting to moderate. I think Dara mentioned that earlier on in one of the questions. Remember, it peaked sort of in the low 20s back in the spring. So as we look forward to 2025, I'd say we expect the insurance cost to continue to increase, but at a pretty significantly modulated rate compared to what we've seen over the last 2 years. And as we've said many times, there's a lot of effort that we have to help drive that insurance cost down and really bend the curve. That includes the deployment of safety technologies that we're putting in, the risk management program we have, which includes sort of the relationships we have with our counterparties and our own captive insurance company. And perhaps most exciting is the effort that we've been making on the regulatory side in driving some of those initiatives where we've actually been able to see success in insurance in a couple states, Georgia, Texas, as two examples, and our principle has been unchanged on this. We pass along insurance cost increases, and we pass along insurance cost decreases. So as we make progress on insurance, you'll see us continue to pass those benefits on to our riders.
Okay, so one more question. So we have 2 questions on autonomy, 2 questions on insurance, and a number of other ones. But in this response, the CFO pointed out exactly what we discussed earlier. On a macro level, CPI for motor vehicle insurance in the US was up 16% year over year in September. So it's more of a macro phenomenon, but specific to US, he said, which is also interesting. And I think, like I said, so this actually strengthens my understanding and my point earlier that I think Tesla's in-house insurance company and FSD being a superior driver than a human driver in the future could be a very strong competitive advantage against Uber. Now, the CFO also says that they have, he says, a captive insurance company. So he says, the risk management program we have, which includes sort of the relationships we have with our counterparties and our own captive insurance company. So that's interesting. And then the third thing that he pointed out is they've seen success in insurance on the regulatory front in a couple of states, including Georgia and Texas, as opposed to the earlier states that the CEO mentioned that where the insurance costs have increased the most, New Jersey and California. So New Jersey, California, Democrat states, Georgia, Texas, Republican states. So yet another reason for Elon to be focused and kind of be frustrated about these things from the left versus the right. All right, let's continue.
Let me pass off to Dara to take your question on advertising.
Yeah, absolutely. So advertising, we're obviously very, very pleased with the growth of our advertising business. We've always said that in delivery, it can get to 2% plus of gross bookings. We're in the mid 1%. So we're right in between 1% and 2% at this point. So we're making good progress there. And if I were to generally split our advertising business into kind of 4 different categories, one is the CPC kind of bidding for placement for small businesses. That business continues to progress really, really well. We're able to increase the number of monetizable impressions per user session. So kind of increasing the ad load a little bit with little or no penalty to the user experience because the ads are really targeted. We're showing high quality restaurant and high quality choices to users as well. So our kind of SMB, small, medium business, CPC business continues to grow at very, very high rates. Our penetration with enterprise is generally a little bit lower than SMB advertisers, but that is growing quickly as well. And some of the larger enterprises, they're looking to target different consumers. They're looking to target different segments of the day. For example, it might be breakfast, it might be lunch, it might be dinner, or they're looking for consumers that are net new or incremental. So kind of the tools that we're building for enterprises are a bit more sophisticated in terms of tracking, targeting, et cetera. And we're making really good progress there with our ads team. And then we're really focused on our sponsored listing product. This is for groceries. And these are CPGs, et cetera, the Cokes and Pepsis of the world who can advertise on our grocery product in order to increase their share in our marketplace. And we're very, very early in the development of that product. We're launching about 8 different markets now. Again, looking to mature a tool set for the enterprise advertisers. And then at the same time, we just have to keep building our grocery business to be bigger and to become an absolutely necessary buy for the big brands out there, the big global brands out there. And based on the growth rates that we see in our grocery business and the number of partners that we're bringing in, we're quite optimistic that we are getting there. And then the other area that we're pretty excited about is our mobility advertising. These are our journey ads. We are really kind of restricting that space to very, very high quality advertisers. Click-through rates are 2 to 3 times that of industry averages. So the advertising is getting the attention of the riders. We're very careful there not to hurt the rider experience, which kind of is as a result of our focus on ad quality. We recently announced a partnership with T-Mobile Advertising Solutions to bring our Journey TV offerings to about 50,000 vehicles across the U.S. So we think that will be another jump start to our mobility advertising solutions as well that we're quite optimistic about. Ultimately, we think mobility advertising is an opportunity for us to increase margins, but also increase the ability for drivers to earn more with these tablets, for example, in their cars, to the extent that it improves driver earnings and their quality of life. We think that's a terrific thing as well. So very pleased with how the ad team and tech teams are delivering, and we think we are midway along this journey and have plenty of room for growth ahead of us in all three areas, whether it's CPC or sponsored listings or mobility solutions.
Okay. So interesting that the CFO took the insurance question and the CEO took the advertising question. And he went into a really granular detail here on the advertising side. So they're clearly thinking very strong about advertising, and it's going to be a growing part of the business. And the 80% year-over-year growth is pretty stunning. And he says it's going to be incremental to the margins. So another thing that he mentioned, click-through rates are 2 to 3 times that of the industry average, which I think is pretty stunning too. So they're being very careful about the rollout, the growth of their advertising business. Interesting. Let's continue.
Thank you very much.
You're welcome. Next question.
Next question is from Ron Josey with Citi. Your line is open.
Great, thanks for taking the question. Maybe, Dara, I wanted to stick on the delivery side a little bit here and understand just what's driving the MAPCs and frequencies. I think we said in the letter MAPCs exceeded 50 million in the quarter, frequency reached all-time highs. And so I just want to understand on the delivery, can you talk about just how are new MAPCs coming on for restaurants, or has that evolved a little bit more to newer verticals, just given the investments and awareness around grocery and pretty much everything that Uber has to offer? I guess that's question number one. And then question number two on frequency overall, 25 million Uber One members globally, teen trips up 40%. We'd just love to hear your thoughts on just other initiatives on driving greater frequency across the platform. So one's on delivery, two's on overall frequency. Thank you.
Yeah, absolutely. So on delivery, listen, we're pleased with the results. It's another quarter of 17% growth in terms of gross bookings. And listen, on the MAPC side, in terms of audience, first of all, delivery is, it's a big category. I think the growth in the category continues to surprise many, maybe including ourselves. And it is the mainline Uber Eats business that is bringing on the new audience. I would say significantly assisted by mobility as well. We have the unique differentiator in our marketplaces, which is we have our mobility business with an Eats tab right on top of it, and also actively cross-promoting users between mobility and delivery, and increasingly now from delivery to mobility as well. So about a third of our new audience comes from our mobility business, and it's lower cost audience and obviously very much engaged with the platform. But we are continuing to invest in increasing advertising and increasing brand spend all around the world. And the message that's landing with Uber Eats is obviously a message that is resonating. We gained category position as a result of kind of that increasing audience and delivery in 10 of our top 10 markets. More people are hearing about us, and it is resulting in category position gains that we're very happy about. And then for us, in terms of frequency, number one is just the quality of service, increasing selection, making sure that on-time rates are continue to increase, making sure that unfulfilled or errors in terms of deliveries, not getting what you wanted, continues to decrease. So we are continuing to kind of grind, if you want to call it that, in terms of customer experience. The better you are, the more people stay with you, and you want to avoid those situations where something happens, something unexpected happens, or a poor experience happens, which can cause that consumer to look for alternatives. And then once we have that core experience improved, then the focus is on membership. Members spend 3 times more than non-members. Retention rates are higher for members as well. And with 25 million members, up 70% year on year, you can see the momentum as it relates to that part of our business as well. So I think it's all coming together very well. And you can see it in both the top line results and our margins continue to increase, and in terms of our category position improving versus our competitors as well.
Okay, so a lot of that is just corporate fluff and not much incremental, detailed insight there. For example, the CEO, Uber CEO, loves to mention that members spend 3 times more than non-members, but that's not really. Like, obviously, people who spend more are more likely to become members. So it's not really like you can't really get a lot of insight out of that. It may not really translate to future growth. Like, they have 25 million members right now. When that goes to 30, 35, 40 million members, will they continue to spend 2 to 3 times more? I think I would estimate that number will probably decline. And then over time, like Uber used to say something like, this is very similar. Uber used to say something like, our drivers are twice as safe as an average driver. And then they dropped saying that because it became average as they grew. So kind of look through, think critically, and look through some of this management fluff. And then let's continue. But before that, right now, I see 1,100 plus people, concurrent viewers, listening on X and you watching on X and YouTube at the same time. Take a moment, please, to like and repost this stream on X and like and share the video on YouTube with your followers. It would really, really help the channel grow at a faster rate, which is critical for us to get to contribution margin positive so that we can continue to grow Tesla Live and bring you more of these watch parties, more insight, more detailed deep dives in our spaces, attract more speakers, experts into our spaces. So it's very important that you like and repost and let me know your code check number in YouTube live chat as well. All right, let's continue. 10 more minutes to go on the Uber call.
You're welcome. Next question.
Your next question comes from Nikhil Devnani with Bernstein. Your line is open.
Hi there. Thank you for taking the question and the commentary on capital allocation. It seems like in other areas of the business, whether it's dark stores and delivery or autonomous vehicles, you've opted for more of a partnership approach to stay capital efficient. So I guess could you just remind us how you think about partnering versus buying your way into a new vertical or a new market? What makes an acquisition a better path in your mind? And where does further expansion and diversification of the Uber platform to adjacent opportunities fit in your priority set right now, considering the transition that is happening around the core business with autonomous vehicles? Thank you.
Thanks, Nikhil. We're gonna do this in 2 parts. I'm just gonna do a refresher on how we are thinking about capital allocation to give everyone the opportunity to make sure, and then I'll let Dara kind of talk about how we do those trade-offs between when partnership makes sense. So just as a reminder to everyone, and I said this at the start of the call, our number 1 priority is responsible organic investments aligned with the growth strategy, focused on what's going to drive free cash flow. We've got plenty of opportunity ahead of us. We've talked about on the mobility side, things like hailables, on delivery, we have our groceries and our direct business. And then we have the terrific U4B platform, which sort of spans both products. Back in February, we also said liquidity was important to us and we had a goal of getting to investment grade. We actually got there much faster than we were expecting. In Q3 of this year, we hit IG, which is a great accomplishment for us. And now it really allows us to focus on really the return of that excess capital to shareholders. So we will continue to selectively evaluate M&A, but it's a really high bar and it's going to have to be both strategic value and financially accretive. I think Food Panda is a terrific example of how we think about that, where it was a clear win, both strategically, where Taiwan is such a great market for Uber Eats, given its high frequency and great membership coverage. And then financially, the deal is very accretive with the likelihood that we'll get an incremental $150 million in EBITDA pretty shortly after we close. So beyond that, get our capital back to shareholders. And again, I made this point in the opening, but I want to restate it. The repo program is the primary vehicle on that, and now we feel pretty good that we're going to be at a share count reduction in 2025. So having said that, I'll pass back to Dara now to get into when do partnerships make sense.
Yeah, so generally when we look at partner versus acquisitions, et cetera, or whether we want to actively get into an area, really we ask ourselves, one is, can we really get into an area with the proper focus? Is it substantially related to the core? And then second is like, can we add value? And you know, the example of dark stores, for example, you know, we just concluded when we looked at that segment, there are millions of retailers out there. It is all they do. And we as a tech first company couldn't add a bunch of value to what these retailers were doing. And we'd rather partner with them to extend their reach and then to complement their services in certain segments, for example, fulfilling for them our direct business that allows some of these retailers to fulfill whatever product that they're serving, like a Walmart or an Apple. So if we can't uniquely add value, if it can't be a core focus of the company, we'll look to partner. And for example, with autonomous, we were in that business, but it wasn't, you know, kind of our main business. And we've decided to partner with a bunch of different players out there, the Waymos of the world, the Cruises of the world, the WeRides of the world, where autonomous is all we do. And we can bring them the complement, which is our demand and our operations, local operations, which allows them to monetize the substantial investments that they are making. You know, in terms of adjacencies and how we look at them, we will typically, because of the power of the platform, we will typically experiment with different adjacencies. You know, we've on delivery, obviously, we started with food. We've gone into grocery. You're going to see us getting deeper into any and all kinds of local retail as well. And with mobility, we started with cars, and, you know, we're going on two-wheelers and three-wheelers and buses and trains, et cetera. And we'll continue to kind of test out some of these adjacencies. Typically, we look for behaviors that are frequent, meaning you can get multiple interactions per month, and also can benefit from our expertise in terms of real-time local logistics as well. Our ability to match and price based on inventory on a given day that can change substantially from 9 a.m. to noon to 8 p.m. You know, when we're pricing out our service, unlike you know, traditional retailers, we don't even know what our inventory is. So we have to kind of do a scan of our real-time inventory in every market that we operate. It makes it a very, very challenging but really interesting technical problem to be able to scan that inventory quick enough and then price it both on the demand side and the supply side. So where there are circumstances where we can bring value to that and where the customer interaction tends to be highly frequent or can take advantage of our local logistics and pricing and matching capability, that's where we'll look to act. And first, typically, we like to build things organically. We built a ton of businesses. You know, Eats was built organically here. So building organically is part of the DNA of this company. And then if we see something really interesting, you know, we will look at acquisitions. But again, like Prashant said, we will be very disciplined in terms of those acquisitions because the bar for return on investment is quite high at our shop right now.
Thank you.
That's a really, really impressive answer. And the management, my respect after this call and the earnings release for the Uber business has increased. And I think it's going to be very difficult for Tesla to disrupt Uber, even with robotaxis. Like when that technology is here, I think it's going to be very difficult to disrupt. But we'll see. TBD. So the watch parties and all the discussions in Tesla Live will inform as I build out the DCF, discounted cash flow analysis for Tesla. That's going to happen on YouTube channel. So if you want to be part of that discussion, head over to YouTube channel, youtube.com/@ValueAnalyst1 and subscribe to the channel. It's free to subscribe and turn on the alerts so you get a notification when I start building these, when I continue with discounted cash flow analysis. So, for example, based on this conversation, I think I'm going to maybe lower my expectations of an adoption of a robotaxi business for Tesla, even after the technology is there. So we'll see. Let's see. Let's continue. Just a couple more questions left.
You appreciate it.
You're very welcome. Next question.
Next question is from Ross Sandler with Barclays. Your line is open.
Hey guys, just going back to the autonomous questions. So I guess on the Waymo partnership, why only 2 cities? Why not something much broader? Is that an option in the future? And then you guys are an investor in Wave. Could you talk about how you see the second tier of the robotaxi market behind Waymo and Tesla evolving? When do you see that next wave of companies and fleets conceivably being on the road and on Uber specifically? Thanks.
Yeah, Ross, in terms of the 2 cities, really what you want to get is the proper liquidity in a city anytime that you launch. And with Waymo as well and many other AV players, there's a need to kind of map different cities and map both originations and destinations. So there's an investment that goes into launching these cities. So it doesn't make sense to getting into 20 or 30 cities.
So that's a really important comment for Tesla investors. So Dara, so the question was, by the way, this is the 4th autonomy question, which is amazing on an Uber call. Clearly, the analyst community is starting to think more and more about these autonomous vehicles. And the question was, why are you just doing Atlanta and why just Austin and Atlanta, just 2 cities? Why not more? And Dara's answer was, there is an investment that's needed. They need to map the different cities, map originations and destinations. And that Dara is pointing out that is the limiting factor why they're not rolling out faster. And obviously Tesla doesn't have that limiting factor. So that's a really interesting question and answer right there. Let's continue.
Cities in kind of a thin way. You want to go into a city with the proper investment in your depots, in your infrastructure, in your mapping, et cetera, so that you start getting a return on capital. Waymo and ourselves thought that these 2 cities are very attractive cities to launch in, and hopefully we can go from there. But really the focus right now is to make sure that Austin and Atlanta work the way that we believe that they will. In terms of other players out there, it's really hard to generalize. I think that Waymo is clearly the leader in the industry, but there are many other players who are developing this technology. And, these cars are live in many cities around the world, certainly in China as well. And so you will see deployments of other autonomous partners on the Uber network, so to speak, outside the U.S. coming up in 25. I think that the autonomous kind of ecosystem will continue to expand across many different partners because the potential of the market, both in terms of, saving a bunch of lives with safer drivers out there, but the potential in terms of extending mobility and making available to many, many more people at a reasonable price is just so significant that many players are going to go after that opportunity. And I think we've shown with all of our partnerships that we are by far the best partner in terms of driving utilization and working locally with some of these partners. So stay tuned. You're going to see more launches coming up.
Sarah, we'll take our final question now.
Thank you. Your final question comes from the line of Benjamin Black with Deutsche Bank. Your line is open.
Great. Thank you for taking my question. Can you just talk a little bit about the broader consumer landscape? How favorable is the state of the macro environment for you in some of your larger markets? What proof points or KPIs do you guys track that give you confidence that it's not deteriorating? And then the second one is on Uber Direct. Do you need to supplement that business with some incremental investment to drive deeper penetration? And in terms of your Darden deal, it's exclusive. Is that sort of the right way to think about the direction of travel for the structure of future partnerships? Thank you.
Yeah, so I think generally consumer demand continues to be strong, especially on services. Spend on services still isn't where it was pre-pandemic. So I think all service players, travel, for example, Booking.com, I think reported last night, pretty strong results. So all kind of services providers are enjoying this. And if you look for us, our audience is at an all-time high, frequency is at an all-time high. Our consumer retention is up globally year on year in both mobility and delivery, similar to the past couple of quarters as well. We're not seeing any signs of trade down in delivery. It's something that we look at. So eaters are ordering more from kind of the $2 bucket versus the $1 bucket in terms of our own ratings in all top markets. So it looks like the consumer is strong. And when you look at U.S. and mobility gross bookings in the U.S., for example, they grew 17%, which is a very solid number. And then international actually grew faster than that. So international markets continue to be very, very strong, which is something that we are quite happy about. And then we continue to see very strong spend on the corporate side as well. U4B growth rates are very strong, 50% constant currency growth as we continue to penetrate into new accounts, but actually existing accounts continue to grow as well. And about 50% of our U4B business is premium, which is kind of black and comfort, et cetera. We're not seeing any signs of trade down there. So for now, all the consumer signs are strong, and we're certainly hoping that they stay that way. And then in terms of direct, we continue to invest aggressively in direct, actually. You see the partnerships with Darden. And, some of the partnerships that we have are exclusive and some are not exclusive. It really depends. It's hard to generalize. There are some players who want multiple partners. I think one of the benefits that we bring in the direct business that we are global in nature. So one partner, especially global brands, can partner with us and we can integrate into their tech ecosystem, and we can deliver for them, in New York, and we can deliver for them in any international, in Tokyo as well. And there are very few. There's no one else who really has the global scope that we do. But as it relates to direct, we're actively increasing our engineering headcount there and continuing to sign up more partnerships and also deepen our capabilities in terms of the services that we offer our partnerships. It's one of the fastest growing parts of our business. And we think the extension of direct beyond just same day delivery into kind of more fundamental parts of the fulfillment ecosystem is a real potential opportunity for us going forward.
Terrific.
All right.
Thank you very much.
So I think that's it. Thank you, everyone, for joining. A huge thank you to...
Okay. So just a couple of takeaways from the entire call. Any questions, leave in the YouTube live chat. But in summary, Uber is growing 20% top line, even faster bottom line. So it's a healthy business, healthy balance sheet. We went through the financial statements in the first half of this live stream, and I didn't notice any red flags. Cash flow conversion of the net income is also very strong. They're increasing their share repurchases, returning capital to investors, equity holders. But they're doing that in a way that increasing the leverage of the balance sheet a little bit. And that's, a questionable move by management. Sometimes it can be good, sometimes it cannot. Maybe it's not good, but that shows confidence that management believes that the business is undervalued currently in the market. Okay, so even at these high interest rates, leveraging the balance sheet to buy back shares is a very strong signal that the management believes that the business is undervalued at the market, and current market cap is $154 billion. Okay, whether that's right or wrong is TBD, and I think that's going to depend on how fast Tesla robotaxi business can disrupt Uber business. They're following very different strategies. Uber is partnering with Waymo, and they're going to have to partner with the auto manufacturer, obviously, and a bunch of other autonomous vehicle companies. And so that's going to be more of a partnership thing, as opposed to Tesla is vertically integrated, in-house development of FSD, in-house build out of their manufacturing capability. And also, as we'll learn in this call, insurance costs for Uber is rising rapidly, especially in states like Jersey and California. And Uber's policy is to pass on insurance cost increases and decreases to the customer, to the end user. So, and they're seeing, as CEO pointed out, there's a high elasticity to demand. As the insurance costs increase, the cost of the trip increases, they're seeing declines or slower growth in the number of trips. So having an in-house insurance program for Tesla could be a competitive advantage when the robotaxis roll out. Okay, so we'll see if the vertical integration approach by Tesla succeeds in the longer term. But at a minimum, in the shorter term, I think that people should keep their expectations of Tesla disrupting Uber low in the next coming couple of years. Even after FSD is perfect and robotaxis start rolling out, I think the moat that Uber is building with the Uber Eats, and he also mentioned other vehicles like trains and ships and flights and helicopters, etc. I think Uber is building a good business. I think that Tesla will succeed in the longer term, but it's going to be 5, 10 plus years out. It's not going to be in the immediate term. Okay, so those are my takeaways. If there are any other takeaways, leave in the live chat, leave in the comments below the video on YouTube or in comments on X as well. And then we're going to continue to discuss our takeaways from this call in Tesla Live on Monday through Friday, 1 p.m. Eastern, noon Central, and 10 a.m. Pacific. Thank you very much, everybody. And we'll chat with you all next time. Take care.